The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman on this very, very interesting day. This is probably one of the, out of the last 3 weeks or so, this could be one of the most significant sessions we've had. I'll explain why in a moment. Oh, it's probably also the most significant sessions we had in a long time, because tonight I will be doing the follow-up of my 1929 match. And I've been working away diligently. I only have 45 minutes. So those 45 minutes are going to have to be very judiciously spent. At the same time, I want to show charts. I want to talk about the theory. I want to talk about the previous price time matches. I want to talk about a number of different things. But most importantly, let me just show it here because I'm liable to forget later on. Let's go right to TFNN. Let's go to the front page of TFNN, and we'll go to 2 free webinars. And the archive, you can get the archive from last Tuesday. Everything that I discussed last Tuesday is still relevant today. All the chart patterns, all the particular charts that we looked at, that is whatever tradables we were looking at. At the same time, you will get live tonight, May the 5th, the 1929 market revisited. Back in February, I had a webinar in which I discussed how this particular time frame, the early part of the 21st century, is matching in so many respects. If you know your history, you will know that whether it's in the arts or in the sciences or the mechanics or whatever it is, there's a period going into the 80s and 90s of any particular period, whether it's Brahms or whether it was Bach, it doesn't matter. You go into that end period, coming into the beginning of the first century, a whole new series of dynamics occur and have to be sorted out. How can I put that succinctly? Think of it this way: when you get to a very stark period, and then you get like in Baroque music, and then that develops and it becomes more classical as the form becomes more solidified, more people use the form. Then you've reached a certain level, and what happens, you've gone through the Bach, you've gone through the Haydn, the Mozart, and then you get a Beethoven who takes this and he breaks it up and he says, hey, that's fuddy-duddy stuff. I'm moving into another sphere, just like Carl Philipp Emanuel Bach's, the son of the great Johann Sebastian Bach. The same way as he took his old father's stuff and said fuddy-duddy, and he created a whole new form. You don't hear all that much about him, but if it wasn't for him, you wouldn't have gotten to the classical form. He was the pivot point, and that's what happens at turns of the century. You go from Bartók and Stravinsky and Picasso, and you break through the Romantic period. You get to a little momentary Impressionist period, and then you break into something modernistic. You go from the horse and carriage to the automobile, Mercedes-Benz. Benz died 100 years. What did I just see? Oh, it doesn't matter. So what you're looking at is a period where there is a new, whatever it is, then there has to be an infrastructure that's built around it. And once you've got that infrastructure, you go to the modern period. And that modern period invariably creates some kind of chaos at the turn of a century. Wars break out, all sorts of things break out. And then you get another period of classical. And we are in that modern period. We're in the period of new ideas, new concepts, Tesla is a very good example of it. But it is the beginning. And if you know your history, and I'll go just a touch into it tonight, what's ironic is that Mr. Buick died in 1929, just as Buick was really coming on strong as a car company. What did I do? Close your TFNN. Close my TFNN. Oh, okay. This is my TFNN right there. So these are the free webinars. So, and tonight is one, and you will get, you'll have the archive of last week. You'll have this one, and you'll be able to have it for 30 days, plus my newsletter for 30 days. So free. So this is a very interesting period. Why? Because within the time frames that I like to look at, this beginning of the century, going from the tens into the teens, we're in the teens now. The teens are when you start to get the sorting out of what should succeed and what shouldn't succeed, but at the same time, the branches of the tree are breaking out significantly. And eventually that has to be whittled away. So you only get your 5, maybe 3 automobile companies, 5, maybe 3 CNBC, ABC, CBS, communications companies. This is one of the critical periods, and we're going into it right now. Right now meaning not just today, but in this phase going into next year. And I'm going to be discussing that. And we should, in fact, see the market, I think, continue higher after a good pullback. And that will be the coda to the coda. And I'll talk about the coda to the coda. But doesn't mean that at the end of that you get the depression. Doesn't mean that it's all over. I'll talk about that as well. I'm not so sure that things match so parallel, but there will be a downward move. My thinking for a long time, I'm talking 20 years, has been that we are getting closer and closer to the war on capitalism, and that the United States, I hope I'm so wrong, I just hope I'm wrong, that since the 1990s has essentially been exporting capitalism and democracy, and importing other things. I don't even want to go there. But we've got to face the facts that there are certain things that are happening, and history repeats. So we're going to be looking at what could happen. And that's not to say I'm still not expecting a period of real exuberance to come before we make a major top. All right, let's go to the numbers, and the numbers are the Dow's down 64 at 18,006. The S&P's down 12 at 2101. The comp index is down 55. That's big at 49.61. Gold is up about 8 points. This is going to be a very interesting period for gold. I still think the downward pressure is there, and that's going to be very important. What happens to bonds? Bonds right now are where the bonds? The bonds are down a point again at 155 and 21/30 seconds. The TLT is down 95 cents at 121.88. And we've got silver is up a tad, up 12 cents at 16.50. Platinum is up a little bit. High-grade copper is now up at 2.94. Hey, come on. Let's have a look at that. Oh, let me just show you this chart before I get out of it. There's your peak D. What do you look for in the Chapman wave methodology? You look for at least the fourth highest peak. That's where other things can happen. Kaplop, look at this. We've gone right through the 200-period exponential moving average. You did go to an E in the daily chart, and that still says this is a right arm extension. This is a right shoulder failure pattern that we're looking at, which is what I mentioned to my subscribers. Very important session coming up. One of the reasons why we've been packing the short side for a little while now, and we'll see what happens. All right, so that's that, and the dollar is at this particular point, the dollar is kind of weak, bounced away from the 9-period exponential moving average, which means this is the opportunity for gold to be moving high. Yep, it's moving nicely, But until it breaks into the 1220, 1230 area, to make higher highs and higher lows, we've got to be a little bit careful here with gold. And now I want to go to our first caller. We've got Scott in Safety Harbor. Scott, how are you? I haven't heard from you for a little while. You okay?
Good to hear from you, Basil. Hope you've been out on the tennis court. I mean, the weather all over the nation's been fantastic.
Yeah, I've been playing a lot of tennis. Outdoor tennis, if you can believe it. That's the weather now. Beautiful.
Absolutely. I've been playing with Gilead as usual, and was a little surprised that on the earnings day it didn't pop, but the day afterwards it did. But I want to look at Apple today. Very curious about Apple's movements, and I'm just looking at an entry point at 124, 125. And then I think after it pulls back to that, it retraces back to that a little bit, I think we're going to have a surge past the highs of the other day, which was 135. There's just nothing bad in their bag of tricks here. I think the watch is absolutely ridiculous, and the Beats thing was a bad investment, but nobody else seems to think so.
I looked at the watch the other day when I was at the Apple store, and it really, they produce such fine works of art. It is really just a beautiful work of art. Anyway, let's just get to the chart, which is a work of art in itself.
I think that's the best way to look at it, a work of art, because, it has to be tethered to the phone, for goodness sakes. It doesn't, it's just ridiculous, totally ridiculous. But
So let's just do this. 133 was a round number, closing high on the 23rd of February. It was also the high. And that said that the following day, it went to 133.60, 60 cents higher, and then pulled back. And for me, this goes into the category of one of the techniques that I had a webinar on some time ago called the silent candles, the silent indicators. And one was a particular doji pattern, and the other was a round number the day before a turnaround, either up or down, because it isn't noticed by the crowd, because the following day is really the high that makes the difference, or the low. So what happened is you went to a peak G, an alternate count turned out to be a G, and then you produced a bowl or cup formation. A cup formation is when you're going from the left side to a low point to the right side, and you do it in a reasonably shaped pattern that looks like a cup. When it extends too far, it looks more like a bowl, but the end result can sometimes be exactly the same. And what I was talking about, I can't remember if it was yesterday or the day before, I was looking at Apple. I think someone might have called about Apple, but I was looking at Apple at 134.54 was the high. And what I'd said was that was a perfect 4 ways to the top. Now what's going to be very important in the pattern that I use as a template for looking at the cup formation at the top, what I call a double top formation, is I call it the Chapman wave drop bucket formation. And there's a specific set of parameters we look at, which I'll talk about as soon as we get back. We've got Scott in Florida, Safety Harbor, and Apple's at 126.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they just recently unveiled the new 5-year market-safe Future Economies CD. This is a CD that could really deliver, but you have only until May 7th to take advantage. Consider the facts. If the Future Economies currencies beat the US dollar over the CD term, you'll get all of the upside. And should they lose? No worries. There's zero downside risk here, as you'll still get back 100% of your deposited principal. Intrigued yet? The May 7th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
Basil Chapman has just announced 2 live workshops that he'll be hosting April 28th and May 5th that only subscribers to his opening call will gain access to. On April 28th, Basil will host a 45-minute live online workshop, The Essentials of the Chapman Wave, where he'll teach the basics of the Chapman Wave notation that Basil created and uses daily in his trading and newsletter recommendations. On May 5th, Basil will host a second 45-minute workshop where this time he'll revisit the 1929 market comparison webinar and provide his attendees with an updated take on the socio-economic trends Basil has spotted currently taking place. If you're an opening call subscriber already, then your seat is already reserved. If not, then sign up for a 30-day free trial to the opening call today. You get a month of Basil's daily newsletter, The Opening Call, along with 2 live workshops coming up. Don't miss out on this offer. Sign up for Basil Chapman's Opening Call newsletter today on the front page of TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back. Oh, what happened to that? I spent all that time trying to get my autoplay. Oh, there it is. Let me just get this out, and I'm going to show in 1 second. We've got Scott in Safety Harbor. So, Scott, this is what I'm talking about here. I'm going to show a chart just in a moment. Oh, it's a little slow today. Okay. In this particular, introducing the Chapman Wave methodology, a CD book that I've done, it's only available at TFNN. There's a chapter that I call, well, it's a double top formation. I call it just as a kind of a catch heading, the drop bucket formation. Just took a sip of seltzer water there. Throat getting a little scratchy. Got to get it ready for tonight. And what we're looking at is within the patterns that we always follow, there's a pattern that I call the drop bucket. And I use that just kind of as a catch-all phrase. But basically what it says is that when you make a double top, it looks like a backhoe that's picking up the trash in the, or whatever it is, in the the bucket, and then it just dumps the bucket at that top. And that's the visualization that I really want you to have. And if you look at the 133.60 high that was made in Apple's daily chart back in April, and then the high that was made, February, and then in the April high of 134.54, less than a point higher, with that news-related gap to the upside, lousy candle to the downside. What happened was it broke 1/3 to 1/2 of the distance between the lip on the left side, 133.60, to the low that was made at 122.40, was it? 121.63 back on the 12th of February, 12th of March. And then what happens, it climbed its way to a peak A, B, C, it pulls back, and goes back to a D, new all-time high. But the weekly chart turns out to do the same thing. It's, again, the cup formation. This time, instead of a bowl, this really looks like a cup formation. My suggestion is, and I think you're absolutely wise to not be doing anything right now, but to be waiting for a pullback, the really big test, and I've got a feeling this time it's not going to hold. That's the impression I get from both the leg F/B in the monthly and the E, which is, I can't have any alternate count. I think it's an E in the weekly because the MACD and stochastic are failing. So there weren't enough technical strength components to the move to the new record high in this last move. And as a result, you can see the sharp decline. So two things are happening. One is it's at 126.57. If it breaks under the candle of last week of 124.58, I'm going to say 124. If it breaks under that, then you're going to have to wait to see whether or not we're forming the rectangle pattern. That's the one I drew in a long time ago. I drew this pattern to say there's a chance that Apple could now trade a little bit higher than the 133 high that had made in February, and maybe a little lower than, was it also in March, the low of the 121.63 area. But if it closes under 121 at any particular point in the next 3 weeks, that's going to suggest we've got to now start looking at the monthly chart, and that's going to be really important. So here's my thinking. Since you don't have any position right now, the 200-period exponential moving average and the 120-minute in that rare peak G to the upside, that right arm extension, says that a pullback, again, underneath 125.91, which is the 200-period moving average, this coral, thick-colored moving average, if there's a break under that, the really important lows that we're looking at just on the short term will be 124.58, 124.46, and all the way down to 122.60. So that's the 2 points. So I'm going to suggest that you hold off and just wait for the price to pull back, and only if it forms some kind of a base would I start.
Well, one reason that I had picked the 125 was two other day traders that I know that don't know each other have both buy orders in the 125 range. So I think that there may be, they may not be the only ones. So I'm just thinking if when it gets back to that range you're talking about, I think that we're going to have a snap to the upside because, you know, there's going to be buyers at that 120, 124.90, 125.
So can I just ask you this question then? What do you have, what do they have for stops, or don't they have stops at this time?
These particular guys don't use stops, and I seldom do either myself.
Okay. Well, then I'm going to, all right, hold on, because I want to make another suggestion. You can use it or not, but I'd like to at least get it out there because it's the way I'd be thinking. Hold on, and I'll be right back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back, and we're looking at a Dow that's now down 111 points, and the S&P is down 18 points. This is not a good day, and the comp index is down 90. So let's go right back to Scott in Safety Harbor, Florida.
Basil, I want to say something about stops for a second. I mean, every trader's different. If people are listening to this, I mean, it depends on how much money you're working with and if you're really holding the pulse. I mean, as you know, I hold the hand of these things every second. It's
correct.
It's a big difference. So, I mean, for the majority of people, 99% of the people, you better put stops in. I mean, I didn't put a stop in on Alibaba, and I cashed out. I was in it at 106, cashed out. Finally, I couldn't take the pain anymore of 89 the other day, and lost a tremendous amount. But, I mean, it's just the way it works when you're day trading. Some lose,
right.
Some win. But, I mean, as an overall rule, I mean, you've got to put stops in.
Okay, so I just wanted to the reason why I asked you is if they had very wide stops or very narrow stops would give me a sense of what they were looking at. So they are really looking, the people that you're talking about are looking for a pretty good balance that they would anticipate that Apple is going back to test the 133s. See, I have a different opinion. I think that Apple for now is done. I think it might go into a rectangle formation. All the news, every bit of good news seems to be already written into the stock. I would suggest that it's probably, at this particular point, I wouldn't short Apple, because at any point it could just blink an eye and it could move up 6 points or 3 points or whatever it is. But my eye says
here's how we have faith in it, Basil. I mean, it's like a girl I knew once that had a trust fund. She made a lot of different mistakes in the investing world, but she still kept getting that big check every month. And I think that's the way with Apple. Even though they can make some mistakes with watches and different things, they still got that check every month from those new people buying that iPhone and the people that break that iPhone buying it every month. So
you're absolutely right. Absolutely. There's a residual there, and that's why I've called them basically like the General Motors of the 1920s. So let's do this. All I'm going to say to you is I can see what your plan is. My own preference would be to wait a little longer for 124 to 122. That's the area that makes the rectangle and suggests that if there is a bounce, look what you could get. You could get a retest of the 128 to 130 area, and even then it could fail at that level, but that is a really nice percentage gain. That's just the way I'm looking at it. So I'm going to suggest that I don't want to change your thinking. I want you to just get out that my preference, 125 area, is the 200-period moving average, and the 120, the way the force of that single leg spike the other day has the characteristic that I look for in the H pattern in the Chapman wave, and that H pattern suggests that there's going to be a retest of the baseline, and that's between really 123 and 122. So
what
we'll
we
see.
Really need for Apple is for Apple to step out of that spotlight, and the only way we can get it to step out of the spotlight is something else steps in it. But as long as CNBC and every other financial show only talks about Apple, 90% of the show, we're going to have that upward momentum all the time, and we need to get it out of that spotlight so we can see what Apple's really worth.
Scott, look how much they talked it was almost boring when they had Buffett on once again. And look what's happened to Berkshire Hathaway stock. It's a fantastic company. He's an amazing manager of businesses, and yet the high that was made back in 2014 at 152.94 has not been able to be taken out. It is in a down channel. It's going to take a little while before Berkshire Hathaway turns around. So yeah, I'm with you. Forget the CNBC stuff and look at what you're trading, look at what you're doing, and I suggest to you that you might be right with 125 for a bit of a bounce. I think that the better bounce would become if there's a successful test just a little bit lower down. Hey,
I agree. Thank you very much, Basil, and you're the best on radio. You're still the best.
Thank you very much for calling, and good luck with the trade. So Berkshire Hathaway, folks, has made a sudden spike up to leg C, but that leg C is finding this tremendous resistance from back in the 18th of March at 146.55. Today's high is 146.42. Hasn't taken it out yet, but the most important thing is how will the stochastic turn around in the weekly? How will the MACD finally cross positive, and when will it do that? I'm suggesting that Berkshire Hathaway is going to be pulling back, and what has happened is that they've raised the shorter-term base to be a successful. It's at 145.21. The 142 to the 140 area will be the first real test of this new segment that's coming down. If it breaks that, that's a real problem, not just for Berkshire Hathaway, but for the general market. So I'm saying be careful, and I'm saying be careful also with Apple. Unless, of course, like Scott, you're there right every second, and you are just managing that trade constantly. Now let's do something that is appropriate, because I wanted to give a little bit of this hour to time, so that in the hour just before noon, and now we're in the half hour before noon, I could have a look at the volatility index. So what happened the other day, and the other day was yesterday, we went down to 1210 in the volatility index and closed not nearer the high, but way off the low. To me, that was one of the best signs. One of the best signs, that is, that there has been a huge testing of the 12 area in the volatility index, which is telling me that if there's a close at 1170 or lower in the next, I'd even go up until today's Tuesday. I'd even go up until next Tuesday for a whole week. If by this time next week, the VIX index hasn't taken out 1210 to go into the 11s, but instead is pushing towards and maybe going above the high of a few days ago of the 30th of April, above the 1529 high, that cup formation that I drew in the weekly chart right there, and we've already gone, let me just double check, 1251, 1250, 1212, 1233, that's D. Okay, and then we went to an E. So we've already made a trough, a leg E. We don't know if it's a trough yet. In the 120-minute chart, no, I'm sorry, I meant to say the weekly. I was doing two things at once. Obviously couldn't do it that time. I'm an even painted green, just for the moment, to see if that's going to work. I'm suggesting that there is such internal weakness within the major sectors that the upside is very limited. I'm also going to suggest that if you look at those sectors that have been predominant and that have really created the milieu, the tidal moves to the upside, they're beginning to get very weak. Look at the QQQ, which is dependent. Oops, where did it go? The QQQ series, 1, 2, 3. The QQQ series could not make it. It's making that H pattern. What is the H pattern? Let me just get that H pattern here. And that H pattern will be chapter, I believe it's 17. Let me see. Yep, there it is. Chapter 17, the dreaded H, the lowercase h pattern, which looks like this. Comes down, tries to rally, fails, takes out the left side low. Comes down, tries to rally, takes out the left side low until it makes a bigger arch. Or it could even turn into the lowercase m pattern. And I'm suggesting that we're looking at that H pattern in the QQQ series. And that H pattern suggests that if it takes out 107, closes at 106, I'd say under 106.80, any day in the next 3 days, going to Friday, let's say. That's going to show me that the weekly chart is maybe making a peak that will see the QQQ series start to trade under the 9-period exponential moving average. Hasn't done that until that little shaky period late 2014. So we'll be looking at this very closely. The IBB right now is down 560 at 339. And most importantly, the short that we had yesterday at 348.20, for a change, I made a very tight 1.90 stop. It was a 0.54 loss we took. It just got stopped out, went to 350.74, unbelievable. And now it's trading 10 points lower at 339.34. But we're not crying because we do have the inverted short position of the ETF on the IBB, so cannot complain. And we're still short right from there, and that's fine. But the real issue is the QQQs are relying to a certain extent on some of these big cap biotech stocks, number one. Number two is, within the context of the patterns, there's that rectangle. I'm talking about Apple, remember? Patterns, I'm always fascinated how patterns repeat. You can go to, sometimes you can go to a material or a high tech, or you can go to oil, or you can go to a defensive stock. And lo and behold, the pattern that suddenly started to appear is appearing everywhere. And what is that pattern? It's the H pattern going to test the rectangle formation lower left side. And if that starts to fail, watch out. If there's a close in the weekly chart below 330.60, the low of the week, low of last week, that'll be a big negative because there's very little support until you get to the low 300s. 300, in fact. So we're going to be watching that real closely. And that's going to impact other things. I talked about the XLV looking very toppy. There's the H pattern. Once again, lowercase h. Pulls back sharply, makes the arch formation, and now is pulling back. And there's the H again with a rectangle in the weekly chart. This is the S&P Select Healthcare Spider funded. 72.37 down 77. I had started to look at, Let me just check something here. Darn. I forgot. I was going to short this. It's too late now, but I'll mention it because it's too late. I'd done a lot of work last night on the PPH. What is the PPH? It's the Market Vectors Pharmaceutical ETF. Leg E, possible peak E this month in the monthly chart, as the technicals, which are really strong, are just turning down. So that's not a sign we can use other than to say it's not even a yellow light, but it's a heads up. But wait a minute, this could be a peak F top, but not an alternate count B. In the weekly chart, how will we know? If by Friday the PPH closes under 69.90, it's at 71.09. Now let's be safe. Let's go 69.50. Why? Because there's a trend line, an up channel trend line in the daily chart, which is very far either from the high or the low. So you've got to use the dashed line. And that dashed line says that a close below 70.60 is going to be a negative, but it's the left side low of 70.52. Close below that, and you've gone trough A, trough B, leg C, and that would target this channel, red, key support. And that support's way down at that 69 area. That's why I say 69.50 starts to take you underneath, and that would be a big negative. So slowly but surely, we're seeing the best of the best sectors start not just to pull back, but to succumb to technical underpinnings that are failing. And that, to me, is really important. It's all very well getting the letter right at the top and thinking that there's a turnaround. What was the stock I looked at the other day? I said to my subscribers, watching this real closely, TRW, no position, watching it real closely because I said the peak D weekly looks like it was a takeover candidate or something. Leg D, and the monthly has already made a peak F, but it hasn't gone out of that range. Oh, is this a takeover? Is there something happening here with TRW Automotive Holdings? I don't know. Anyway, it had that spike yesterday, and if I was going to short it at an E, because look, the stochastic and MACD are terrible in all the positions. So something's happening. Maybe there's takeover talk. I'm not sure, but I didn't want anything there. We don't have anything on, but I'm watching it. Why? Because it's in the automotive. Remember I said that my belief is we're in maybe the 5th week or so of a mini recession. And if that's the case, then wait a minute. It makes sense that you're starting to see some of the auto parts companies, not just the auto companies, but the parts. Look at this. AZO makes a high of 704.45 on the 13th of April, and then it goes to what? 705 round number high. Oh, I forgot all about that. 705 round number high. I always look at round numbers, especially at potential highs or potential lows. This is what we've been waiting for. And that says there's that H pattern once again, makes the cup formation, the one I just spoke about, the double top, the drop bucket formation, turns into the H, lowercase h formation. Peak D in the weekly, F in the monthly. I would suggest that we be a little careful here in the market. I'll be right back. And S&P asks about what the count is at Facebook. I'll be right back. Dow's at 84.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Do you know the 7 most critical factors that influence every decision you make, and how not knowing these will jeopardize the health, the wealth, and the relationships you deserve? I'm Steve Rhodes, morning host of TFNN.com, and for the last quarter of a century, I've studied and used the secrets of human growth, the same formulas used by leaders of nations, billionaires and millionaires, and the most successful athletes on the planet. Would you like to break through any obstacle that gets in between you and the success you deserve? Would you like to turn fear into strength? If you could find a way to achieve, be fulfilled, and live a life of meaning, wouldn't you want to know the answer? I'll teach you the factors that control your state of mind and the drivers that impact every thought, emotion, behavior, and action we take in my new webinar, The Psychology of Trading. Join me for this 2-part online event where I'll unveil the secrets to human pattern recognition, because they're not what you think. And soon, you'll have the health, the wealth, and the relationships you deserve. Just go to the homepage of TFNN.com and click on The Psychology of Trading to begin your journey now.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks, we're back. So a couple of things going on here. If Asia AutoZone, let me look at AAP. AAP, which is American Advanced Auto Parts. Yep, also turning down sharply. Let me look at Orly and its spectacular earnings at one point and spiked higher. Yep, there's that gap. Remember, that was that Friday, or I think it was a Friday, gap to the upside, peak E, maybe a peak F in the weekly. O'Reilly Automotive, wow, you got to be careful. And even the question in the den was, Basil, well, first of all, Facebook, I don't like S&P. I don't like Facebook at all right now. It's just acting very poorly. Then the question is, why do you think it is only a mini recession and not more pronounced, Basil? Because I always start off with the near-term goals. I don't want to say, we're into a massive recession or anything like that. because I think this is what I call mini, meaning that there is a slowdown. I think it's 2 quarters of weaker earnings. I can't remember the exact definition, but whatever it is, that's what I believe based on many of the technicals that I'm looking at. That's number one. And number two is when we're looking at the charts, even a Home Depot, well, look at Ford. Look how badly Ford is doing here. General Motors couldn't hold support. This is not good. Home Depot, way off its peak F. This has to be, there's no other way I can count it in the weekly. Peak F, but it might be a peak E in the monthly. I'm looking at this and I'm just suggesting to you, most of my indicators are very weak. I'm not looking at anything more than if there is a huge bounce, the bounce is just going to make nominal new all-time highs, and then we'll come back down. Then we'll go into a trading range again. My feeling right now is that this is the first time I see the chance to start going to lower lows and lower highs. But we're in this trading range. Remember, this is what I show my subscribers every day, right there. We're in this trading range between there and there. That pink line has held the Dow resistance. Yesterday it was at 18,133. So this, you've just got to be real careful. And the other thing is the support is going to be at 17,800 to 17,700. Let's see if it holds. If it breaks down, then we're going to be looking at the 17,500s. I want to go step by step. And this is suggesting from the Dow chart alone that since the very beginning of March, late February, that we've been in some kind of an economic pullback. That's all, keeping it as simple as possible. Now, I believe that you're going to go to Kevin Hinks for the Think or Swim Options Hour. So before we do that, just one more time, real quickly, you got time to still join in this evening, 5:30 Eastern Time. One of the 2 free webinars to subscribers only, but you can become at least a subscriber in name alone, but not in cost, because it could be free for 30 days. Check it out. Go to the front page of TFNN. But today is the one that's really important. Tonight, the 1929 market revisited. To me, that is, I'm going to discuss the what-ifs, not just the ands, what has happened, but the what-ifs and what to look for over the coming months. It's going to be months. And I still expect after any substantial pullback, we will make new recovery highs and all-time highs. But it's what happens in between and how we go into the coda of the coda. That's what I'm looking for. So with that, we just about wrap up. Let me say that if the Dow closes sharply under the 9-period exponential moving average, which right now is at 18,016, and the Dow is at 17,986. And then tomorrow there's another weak session. That's going to suggest that the 9-period exponential moving average, that maroon line there, is going to become resistance. If for whatever reason there's just a sudden spiral to the upside and the Dow closes down only 20 points and the S&P makes a comeback to -2, I'd say that's very good action. That's keeping us in this trading band. I think the trading band is going to be tested to the downside soon. All right, that's it for me. Thank you for being here. I hope to look forward to you. See you tonight at my webinar. Have a great day, and I'll be back probably with Tom a little later.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.